Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mitigating Counterparty Risk, Strategies for Smart Investors. Collateral requirements. Collateral serves as a financial safety net. When you require a counterparty to post collateral, it's like adding a security guard to your financial fortress. This adds a layer of protection if they can't fulfill their obligations. The tools you need are already in your toolbox. Margin calls, regular assessments ensure that the collateral matches the exposure level. If the exposure increases, more collateral is required. Types of collateral. Cash, securities, or other assets can act as collateral. Choose what aligns best with your risk management strategy. Collateral requirements protect traders from potential losses due to non-performance. They ensure that if one side doesn't deliver, there's still something of value to recoup against potential losses. Netting agreements. Netting agreements function like a financial safety valve. These agreements allow parties to offset mutual obligations, resulting in a single net payment obligation rather than multiple transactions. It's akin to balancing credits and debits in your checkbook, where you only pay or receive the difference. Consider these points about netting agreements. Reduced exposure. Instead of counting each transaction separately, only the net balance is exposed to risk. Simplified processes. Less paperwork and fewer transactions make the process smoother and less risky. Enhanced predictability. Knowing the net payable or receivable amount aids in better cash flow management. Through the use of netting agreements, businesses can drastically cut the risk and complexity associated with multiple financial transactions. Netting ensures that only the net amount is at risk, reducing exposure and fostering more predictable financial outcomes. Real-world examples of counterparty risk. To truly understand counterparty risk, it's helpful to look at real-world examples where this risk had significant consequences. Seeing how institutions and investors have navigated these risks can provide valuable insights for managing your own financial dealings. Lehman Brothers collapse. The collapse of Lehman Brothers in 2008 is one of the most striking examples of counterparty risk. When Lehman filed for bankruptcy, it wasn't just a big deal for them. The ripple effects were felt across the globe. Financial institutions holding Lehman contracts faced massive exposure. This event highlighted the dangers of interconnectedness in financial markets. Many companies struggled to cover their losses, showing the critical need for comprehensive risk management strategies. Egg bailout. During the 2008 financial crisis, American International Group, AIG, needed a government bailout due to its involvement in credit default swaps, CDs. AIG's partners found themselves in a precarious position, scrambling to protect themselves from the fallout. This situation underscored how vital it is to assess counterparty stability. The AIG scenario revealed how widespread exposure to one counterparty can lead to a systemic problem, prompting risk assessment reviews across the industry. Enron crisis. Enron's bankruptcy in 2001 serves as another cautionary tale. As numerous financial institutions and energy companies had counterparty dealings with Enron, its sudden collapse left many facing unexpected losses. The aftermath led to more stringent regulations and oversight, particularly around transparency and financial reporting. This case shows why vetting counterparty credibility is crucial to preventing exposure to catastrophic risks. MF Global's bankruptcy. In 2011, MF Global's bankruptcy highlighted the perils of counterparty risk in derivatives markets. The firm's overexposure to European sovereign debt and misuse of customer funds for proprietary trading caused a collapse. This incident emphasized the importance of transparency and effective risk mitigation strategies in financial services. For counterparties involved, the MF Global case reinforced the need for rigorous oversight practices. Russia's debt default, 1998. In 1998, Russia defaulted on its debt, resulting in significant counterparty risk for global financial institutions. This event demonstrated how geopolitical shifts can suddenly impact financial stability. Investors worldwide faced increased risk, prompting a re-evaluation of exposure to emerging markets. The Russian default showcased the unpredictability of global finance, highlighting the importance of political risk assessment in counterparty risk management. These examples reflect the broad impact counterparty risk can have on financial markets. By understanding these historical events, investors and institutions can better prepare for and mitigate similar risks in the future. Future trends in counterparty risk management. The landscape of counterparty risk is shifting rapidly with technological advancements and regulatory changes. Staying ahead means adapting to new tools and frameworks that redefine how risks are identified and managed. Let's break down some emerging trends shaping the future of this vital area in finance. Technology's role in risk management. Technology is transforming how we manage counterparty risk. Think of it as a new toolbox, filled with digital tools designed to make risk management more precise and efficient. AI and machine learning. Artificial intelligence brings sharper insights. Algorithms can process vast datasets, identifying patterns and anomalies that human analysts might miss. This means quicker, more accurate risk assessments. Blockchain technology. Blockchain provides transparency and security. It offers a decentralized ledger that ensures transactions are traceable and tamper-proof. This could significantly cut down on the risk of fraud and enhance trust. Real-time data analytics. With real-time analytics, information flows seamlessly. Investors can monitor risk in the moment, allowing for proactive adjustments that keep portfolios secure against sudden market shifts. Technology is revolutionizing risk management, providing tools that help investors stay agile in unpredictable markets. Regulatory shifts impacting risk management. As governments and financial bodies update regulations, the rules of the game change, too. It's like getting a new playbook, and staying compliant means knowing the moves. Stricter compliance standards. New regulations demand more transparency and accountability. Financial institutions must disclose counterparty risks more explicitly, pushing for improved documentation and reporting. Cross-border collaboration. Globalization means more international regulations. Countries are working together to harmonize rules, making cross-border transactions safer but requiring institutions to be more vigilant. Focus on environmental, social, and governance (ESG) risks. Regulators are increasingly considering ESG factors in risk assessments. Counterparties must now evaluate sustainability and ethical practices as part of their risk criteria. Regulatory changes aren't just red tape. They are shaping more robust frameworks for managing counterparty risk, urging institutions to build stronger risk management systems. Adapting to the future. Enterprises must stay nimble to mitigate counterparty risk effectively. Adaptation is key, much like a surfer who adjusts to the waves beneath them. Continuous learning and adaptation. Companies need to foster a culture of learning. Training staff to understand new tools and regulations ensures they can adjust quickly to changes. Strategic alliances. Building strong partnerships with tech companies and regulatory experts can provide valuable insights and resources. Collaborative efforts pave the way for better risk strategies. Scenario planning and testing. Regularly testing various risk scenarios helps companies prepare for the unexpected. Think of it as a dress rehearsal for financial storms. By embracing these strategies, financial institutions can navigate the complexities of counterparty risk as it continues to evolve. Conclusion. Mastering counterparty risk can be the difference between financial success and unexpected loss. By grasping its nuances, you arm yourself with the tools needed to protect your investments. Keep a vigilant eye on the market's dynamics and your partner's reliability, adapting as needed. Use technology and diversified strategies to stay a step ahead and safeguard your financial future. Are you prepared for the twists and turns of your financial journeys? Let this be your wake-up call. Dive deeper into your current strategies. Think about how they stand up to the examples and trends we've explored here. Your insights and experiences matter. Share them in the comments below, and let's get a conversation started about the best practices in managing counterparty risk. Head over to our related content to keep your learning momentum going. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.